If you hire a tax advisor and you're making $10 million and your tax advisor is making $800,000, what has he advised on himself before he even advises you? If I invest in a stock market, I don't get a deduction, but here's another investment I could make and I could get a deduction.
100,000 into oil, I'm getting over 40%, and that's the deduction. But really, that to me is where I look at it like a return. Boris, I got a question for you. Business owners of any level, but we'll just kind of refer to business owners running businesses in excess of $1 million. They make a ton of mistakes when it comes to tax planning or lack thereof. What are some of the biggest mistakes you find in working with these types of businesses when it comes to tax planning?
So business owners don't make a mistake when it comes to tax planning, because once they're doing tax planning, it's already above the mistake. The mistake is not getting the tax planning in place or not doing a tax planning or really understanding the concept of tax planning. And the reason for that is because when a lot of business owners, every business owner started small, at least majority, right? They started from scratch. They started small. They were making very little money. So they started with an accountant that was also very small and is used to doing small business taxes. But as the business owner grew, and as you know, Chris, businesses can either grow by a little bit or they can grow by a lot. But regardless, they grow. When they grow, they often outgrow their accountant, but they still don't know any better about tax planning. And that's the mistake. And the mistake is not really on them, but it kind of is on them. They're just not educated enough to, hey, I actually do need tax planning. And there is such a thing as saving money on taxes.
All right. Well, I mean, you're a tax strategist, so there's a huge difference. And listen, I'm that guy that had to go through what you just said. Multiple times I have outgrown my CPA, but where the problem's always landed for me is finding the right CPA. And a lot of times, like my scenario, I went around, and tried many different CPAs from different referral sources, and none of them were the right fit. And, one of the other things too, I realized is, most of the CPAs I worked with, they were very good at tax preparation. They were very good at, those conversations at the end of the year that usually start in October when it's pretty much too late to do any kind of material planning. And they would say, okay, well, here's where we think we're going to sit. Here are the things you can do. You can put money in a retirement plan, blah, blah, blah. And there was never any time to do any meaningful strategy. Like, is this something you see a lot? I've since found my way, but it took me years and years and no lie. Like let me kind of transition. I even found one guy he did a complex trust structure for me. He was doing all of our planning, our bookkeeping. He was kind of a jack of all trades. It ended up costing me 2 years of 7-figure tax bills because it was just wrong. It was completely wrong. And I wonder how many other people have to go through these things. I mean, do you see this a lot? Is this a common thing?
Yeah, so there's a lot to unpack in what you said. Number one, you're correct. Just doing retirement is not a tax strategy. And at the end of the year, when accountants are talking to business owners such as yourself, Chris, they often rely on their tax software and they click on that button. Let's do tax planning for the individual. I've been a tax preparer before. I know this. And it's mostly like, oh, we don't see HSA on this return. We don't see retirement planning. While these could be good tax planning strategies, but this is not the only strategy, correct?
Correct.
So yes, I agree with you that retirement is not a tax planning strategy, and a lot of CPAs don't specialize in tax planning. And I tell you, it's not just the fact that somebody is a CPA. You could have an EA, you could have an CPA, you could have an accountant. If all they're doing is tax preparation, they don't specialize in it. But you said something earlier is that, Boris, I went through different CPAs and it took me years to get to where I am right now, where I know how to do this right. So one thing I've realized being a tax advisor is that in order for a business, and this is for every wealthy people, 7-figure business owners, multiple 7-figure business owners, those that are profiting 7 figures, which, we work with a lot of business owners like that. One thing I started telling them, if you're going to look for a tax advisor to work with, first of all, we don't care about the accreditation. Yes, CPA is important. Yes, EA is important. But I think it's the experience that matters. But the second thing is that, do they make as much money as you?
That's a good point.
If you hire a tax advisor and you're making $10 million and your tax advisor is making $800,000, what has he advised on himself before he even advises you. Does it make sense?
Yeah,
So
but
like,
how would you breach that question with a potential, tax strategist or CPA that you're interviewing? Like, how do you have that conversation? Did
why
you
don't
just
you
say,
ask
"I
them?
want to see your tax return"?
No, but you can ask them directly. That's what I would do, right? That, yeah, I don't mind if people ask us directly, but I think if a CPA firm or a tax advisory firm shows enough proof of concept, then they don't even need to be asked that question. Like, for example, if the tax advisory firm has made it to Inc. 5000, you kind of already know, oh, this is a seven-figure business. Or if it's top 100 accounting firms, or it's top 400 accounting firms. So that means they're making millions of dollars in revenue where they have reached those accreditation. If they don't have those accreditation, you can ask them directly, be like, hey, look, I'm making $5 million in my business as a profit. And I just need to make sure you know what you're talking about. I want to know how much do you make, and do you use any of these strategies? Like, for example, in our firm, the advanced strategies that I bring to my clients every year, we renew those strategies. I vet a lot of strategies. We do a lot of research, and I tell my clients, well, this one I'm going to be using myself, or this one I'm going to be using myself. My clients, like, I wouldn't want to bring them something I'm not using myself, right? And it gives them confidence. So if you want to find yourself a tax advisor, if you're making a little bit more money than your tax advisor, fine. But if you're making, there's a huge gap, and they have not even been in a mindset of a seven figures, or have not been in a mindset where, wow, I have to pay six figures in taxes, it will be very hard for that accountant to understand you. That's why you will often find why accountants, and everybody can relate to this who's listening to this, they will send you an email 3 days before the deadline and say, by the way, you've got a $400,000 tax bill, right? They will
Absolutely.
communicate that to you over email because they don't know how it feels to pay such a sum amount of money. I've had this situation happen in my own firm. So I want to, like, Chris, you have to understand something, and everybody that's listening to this, accounting market doesn't produce tax advisors. It produces tax accountants and tax preparers. So right now we're constantly hiring accountants in my firm. But when I look for an accountant on Indeed, for example, I don't put tax advisor. It's nobody tax advisor out there that's looking for a job. It's tax accountant and tax preparer. We take them in, we nurture them, so to speak, we train them, we make them a tax advisor. So there's one accountant that was going through this training, and he had a certain client, and he had to consult with a supervisor before he finalized the numbers before the year end. And 3 days before the deadline, he sends an email saying your tax bill is like $450,000. This client, I just happen to know him. He emails me, he said, Boris, my whole vacation was ruined. I was with
Yeah,
my
that'll ruin a
family on
vacation
the
for sure.
beach. I'm like, I'm like, shit. Like, and it's not that that we were wrong in our calculation. This was a new client before any tax planning, but this is how accountants are operating. They don't understand this. Oh, wow, there's such a thing as a six-figure tax bill, and it's not pleasant. And I should not be just emailing this to accountant. The point that I'm trying to make is that, yes, you have to get yourself a tax advisor that's been on your level or is on your level and understands you, and also using the same strategies that he's advising you.
Oh gosh, that is such an important thing, and I think that goes far and wide with every industry. I mean, how can any company or any business owner advise their clients on things they've never even done themselves? I mean, that's a really good point. You're the first person in the space that I've heard say that, and I love that. So,
And I've experienced it myself. I don't mean to interrupt you, Chris, right? So like, as my business started growing too in a tax advisory, I started attracting clients such as myself in my growth. And I start thinking, I'm like, why did that happen? And I realized, oh, that's because now as I start growing and I'm using tax strategies, more advanced strategies. Now I can actually talk about them, present them to my clients as well. So I start attracting those same size business owners. And that's when it hit me. I'm like, in order for a business owner to be very successful with his tax advisor, they have to be on the same mindset level. They have to understand money the same way. Just because somebody is an accountant, a CPA, a financial advisor, an EA does not mean they understand money.
no, not at all. Let's talk a little bit about some of the strategies that you're finding that work really well for business owners. Now, I know you can't pinpoint, one thing because every business is different, every situation is different. But what are some of the most important things business owners or high net worth individuals need to be looking at right now?
So people always ask me, like, Boris, what's the biggest tax write-off I can take? what is like this one thing that I can do? I can significantly reduce my taxes or pay almost nothing in taxes. The answer is simple, is real estate, but it's not simple to implement because give you a little bit of a history lesson, if you don't mind. Before 1986, you could write off real estate losses against your ordinary income. Okay, so you buy real estate, you do debt bonus depreciation, which is basically, you did cost segregation, which is this accelerated depreciation. You got nice paper losses, you deduct it against your ordinary income. A lot of doctors used it for high W-2 earners. Reagan took office. He's like, all right, this loophole is not going to pass, right? We're going to discontinue it. So when they discontinued it, I believe by 1994, between 86 and 94, they saw, decline in real estate. So they're like, all right, we need to reinvent this loophole. And the way they have reinvented it, they said, if you want to take it, real estate losses, you have to be what's called a real estate professional. That means more than 50% of your time have to be invested in real estate. So a lot of business owners, such as myself, or probably such as you, Chris, we're very invested in our ordinary income business, right? This business right here that you're doing and that I'm doing. So even if I buy a bunch of real estate, any losses that I produce, I cannot deduct it.
Right.
Now there are strategies in the IRS tax code that are built around it. For example, you could have a non-working spouse, then you cannot classify as a real estate professional by meeting certain hour rules. So now
exactly what we did.
Exactly what you did, right? All the real estate that you purchased can now be deducted with all the depreciation. Let's say your spouse works with you in your business. Then we look farther. Then a lot of businesses in America, and I was surprised to find this out because we work with clients over 40 states. And I was blessed enough to speak to a lot of business owners. They actually own a building in which their business operates. Because they own a building in which their business operates, guess what? There is no passive loss rule limitations. They can actually take those losses under certain section code of the IRS, deduct it against their business income. A lot of accountants don't know this. So when we get a lot of clients and we see there's a real estate in which their business operates, that's another big deduction for them right off the bat. And the third one, let's say they cannot be a real estate professional. They cannot do, for example, self-rental strategy. But they really want to be invested in real estate and still take all of these benefits. We say, how about you invest in short-term rental? Because if you structure yours as a certain short-term rentals, it qualifies as a trade or business. The depreciation losses can now be deducted against your active income. Of course, this is just one of the many strategies that a lot of people can use, but the biggest write-off, and I've seen a lot of people in the space that if they have real estate, they either pay very little in taxes or almost nothing in taxes, but they have to structure it right. And that's why where you come in and work with a tax advisor that understands these transactions, understands what it means to buy a $2 or $3 or $4 million real estate property, not like a $500,000 residential home, because that's not going to help us taxes.
Well said. Now, let's switch over to oil just because it's a hot topic. It's in the news every single day. And every time you roll up to the gas station, you can't help but notice it's gone up a little bit. And obviously, we got a little bit of a conflict, war, whatever you want to call it, going on in Iran. But with that, really, brings up the topic of oil as an investment. And now oil, I've been investing in this for years. It's very speculative. I've had major losses in oil, but those losses weren't as severe because of the tax write-offs I got from doing that. Can we talk just a little bit about that as an option? And I know solar is still, very lucrative from a tax planning standpoint or a tax strategy. What is your viewpoint on either one of those or both?
Yeah, so solar is tough to identify for almost every business owner, right? So it's like a very particular thing, and now with the limitations on the resident, it's more like on the business side, and not everybody owns a building in which they operate. But oil and gas, for example, it's very tax incentivized because as you probably know, Chris, we have something that's called IDCs, intangible drilling costs, in the IRS tax code, which basically means in a simple language for everybody that's watching, whatever you invest in oil and gas, you can deduct up to 90% in the first year because you have something such as intangible drilling costs, which is almost all the costs besides equipment, okay? And equipment, which is now bonus depreciated. When you combine both of this, you can get anywhere between 70 to 90% write-off in the first year that you invest. So let's say somebody invests $100,000, they get to write off, let's say $90,000. In a 40% tax bracket between federal and state, they'll save $36,000. So clients ask me, well, Boris, I'm still giving $100,000, but I'm only saving, let's say, $36,000. And I tell my clients, think of it this way. Like if you probably know, Chris, like business owners that rack in some good profits every year, everybody invests in the stock market. Everybody puts it into a mutual fund or some kind of automated investment on indexing, right? So I've got clients that are putting away $400,000 or $500,000 a year into stock market, with Fidelity, with Charles Schwab, whoever is managing their money. So I tell them, look, when you're investing in a stock market, you don't get a deduction. But if you invest in oil and gas, you do get a deduction. So why don't you explore this opportunity, the way to diversify your investments, right? And you also get a tax deduction. And that's what they do. They follow that advice and then speak to a specialist that specializes in investing in oil and gas. And if there are any returns on how that works, while getting a tax benefit, because they never thought about the fact, oh, you're right. If I invest in a stock market, I don't get a deduction, but here's another investment I could make and I could get a deduction.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
Yeah, I love that. And, I live in New York, so one of the worst states, maybe short of worst when you compare that to California. But, with oil, I mean, I look at it like if I put we'll talk 100,000 because it's simple math, 100,000 into oil, I'm getting over 40%, and that's the deduction. But really that to me is the way I look at it, like a return, and then if the oil well produces, which, if you get in a good one that does horizontal, like they're pretty consistent these days, then you can produce beyond that. So what you just said is absolutely true. And I love it as a part of a diversified portfolio. I wouldn't say go all in on oil, but if tax
100%
planning,
no, yeah.
yeah, because I on the flip side, just 2 years ago, actually last year, I realized it. I took a $300,000 loss in a speculative oil play, which I did first and foremost for tax planning. But obviously the risk on the backside was, hey, the deal can go bad. And it did. And you're never going to get all of them to hit the way you want them to. So you really got to prioritize that. Now, another thing too that is really important is charitable giving. Now, you can do charitable remainder trusts. You can do private foundations. Like, how do you perceive those as a good means for tax planning or different ways to put money away that you can save on taxes? Because I look at it and we use it, but it's just, I'm using the government's money that really isn't mine to, direct where it's going to go and do good with that. I mean, is that the right way to look at it?
Yeah. So interesting about charitable giving. I wish I had my notes about it because with the Big Beautiful Bill Act, it's changing a little bit, and you're being limited on how much you can deduct. I think there's a floor now of either 2% or 5%. I don't have the numbers in front of me.
5%. Yeah, 5% minimum that you have to give each year of whatever's in the foundation.
And then over, I think you can only deduct. So charitable giving is being limited, but it's not being limited by a whole lot. So I still do think it's a great strategy for those that are in a giving mode, right? So there's people that really give, and there's people that don't give. Okay, for them, it's a bad strategy. I would not recommend it. Yes, they can set up a charitable remainder trust, and that's more like for exit planning. And they should speak to their tax advisor. There's different exit planning strategies. We can talk about some tax-free exit planning strategies. Maybe make the whole podcast of just around that topic. But charitable giving is absolutely a great strategy, especially if you're a giving person and you're like, year end is approaching. I've done all my strategies, but I want to give more charity. Then you can open up what's called a donor advice fund, which I tell people donor advice fund is basically your own bank account for donations. So you transfer the money to your own bank account. The caveat is that you cannot touch it except for donations, but you can donate that money in the future years, but you get a deduction right now. So we do some planning around that as well, but we always want to make sure that it doesn't exceed 50% of the person's adjusted gross income, because if it's more than 50%, it's not deductible in the current year, but it's carried forward. I've seen returns with the big carryovers. I don't know why people don't do proper planning. With some of my clients, we actually have some carryovers, and they say, but that's how they want it, right? Because one thing about tax planning, Chris, which I don't think we've touched upon, is that I tell my clients, I can never tell you what to do, even though they look at me as a tax advisor. My job is to educate you and to show you, and you get to pick the options. So when there's a carryover with the donation strategies, for example, with our clients, I'm like, hey, I just want to let you know there is going to be a carryover. We can decrease it. No, I like it. Let's leave it like this. Let's just carry it over to next year, and I'll have a deduction next year. Perfect. But it is a great opportunity. It is a great tax planning strategy, but to each his own.
I love that. How do your clients find you? Boris M Tax. I mean, do they have to know about you? Do you advertise? I mean, it's not always easy to find a good tax strategist or a good CPA that actually knows how to do these things. So how do your clients find you?
We do a lot of social media content. I put out a lot of content. I talk about tax strategies. I do weekly lives on YouTube Live where we, try to advertise that as much as possible. I also sell a book, S Corporation Tax Secrets book. We just rewrote it. It's over 180 pages. We run a lot of paid ads to it. And that's really how people find us. And I try to put out a lot of educational content for business owners, whether it's through my YouTube channel, through, free PDFs or free training videos online. And as much as I want to reach a lot of business owners, there's too many of them here to reach, but every day we're trying, of course.
I definitely do a lot of the same things as you. It takes a lot of effort. I mean, you kind of, as a business owner, I'm sure you realize this, you have to go from the act of what you're used to doing in your business to then, finding other people to do that work so that you can focus on growing the business, which is all that, those webinars, writing books, doing all the content and all that. So that's what I found. I found my role in my business has changed multiple times. And it's hard for some people to do that. They don't want to get out of the act of practicing, if that's the right word, to actually start building their business. And I think that's a huge problem with business owners is so many business owners get stuck working in their business. Very few of them ever get that exit to start working on their business and actually growing it. And that sounds like what you did. So Boris M Tax, is that what they would do? Just Google that, or like,
if anybody listening to the podcast, and if they want to learn how to save $100,000 more on taxes, I actually just released the training. We're in the process of releasing it at save100know.com. So that's save100know.com. And we're going to be putting that training up on that page in a couple of days. And this is for all the business owners to kind of learn. I will just pretty much teaching all the advanced strategies there for anybody to hit $100,000 in tax savings immediately.
Now, well, folks, we're going to put that link right up in the description. I'm literally writing it down right now, but we'll have that up in the description so you can join that training. Is it just going to be an evergreen? Is it going to be a live training?
No, it's just a simple opt-in page. And then the training is there for them.
Love it. Love it. Well, there's so much more when it comes to taxes that we could hit on, but I think we covered some of the basics of tax planning. Is there anything else that you'd want to add before this episode wraps up that you think would be really, really important for the listeners?
Well, first of all, I just want to say I appreciate the questions you asked. I think you asked some right questions and you hit on some tax strategies, and I can see why you have, I think you said over 300 episodes. And I think anybody that is listening to your podcast should really take very close to what you say, because you've been in this game and you've done some tax planning for yourself, and all the strategies that you and I discussed today. And you asked me, I didn't bring them up. You asked me as somebody, as a taxpayer that's using these tax strategies. I think these are the good strategies you asked me about. And I think that anybody that's listening should benefit by really writing down, taking notes of everything that you and I discussed, or at least the strategies that you and I mentioned. Go to your accountant and ask them about these strategies. And if they can't answer it, go get yourself a tax advisor, because these strategies that Chris mentioned, which again, I appreciate you actually mentioning and bringing it up, like they really do save business owners money on the taxes with proper planning.
I agree. Hundreds of thousands, but it's taken me probably millions of dollars to learn the things that I have, which is why I just kind of want rapid fire with those. But I appreciate you saying that. But you nailed it early on, like when you're working with somebody, you got to work with somebody that's, where you're at or better than where you're at. Because if you're working with somebody that you make more, you're what can you learn from them? You always have to elevate, in business and in life. You just have to find the right mentors, the right people to work with that are at a place where you want to be, not at a place that you've already exceeded. So I appreciate you bringing that up. But with that being said, this has been a great episode. And thank you so very much for coming on.
Thank you, Chris. Thanks for having me.
All right, folks. Thanks for joining us for this episode of Money School Elite. In the description, don't forget that training on 100,000 savings. Okay. That's what you're going to do. So we're going to put it up there, get registered, check that out, and we'll see you on the next episode.